Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, everyone. Ira Epstein of Linen Associates with your agriculture update for this Wednesday. And we are now on the 22nd of March, 2017, about 1:40 p.m. Central Daylight Time. All right, as we take a look at the grains, across the board, they're lower, and that's even in the face of a lower dollar. So we're still facing the prospect of very large South American crops. We're looking at the point where the U.S. is still basically, when you add in freight and distance and shipping, our exports aren't that strong right now. And we're starting to get the reports also coming in as to how the farmers are going to be planting corn versus soybeans this year. So those are the first elements coming in, and we'll see just how much switching goes on. Now, I don't know about the seed that everybody has to buy, when they buy it, the ground preparation, but what we can see is that there's going to be a concerted effort, at least that's what we're believing from a number of analysts, where corn is going to be reduced maybe 4 or 5 million acres, and that shift will go between wheat and soybeans, but primarily soybeans because of where they're priced, and they offer the profit area. So as we look at the bean market, that's weighed on the market, as you can see, because we've gone from 1080 down to 983 on a weekly chart. As we step over onto a close-only chart, you got as low as 998, and you did that days ago, and you've just hung in there. You can see each day it's just sort of bouncing. Is that basing? It could be. We have to wait and see how it's all going to play out. When we come to a daily bar chart, which is just showing on a bar the high, actually the open, the high, the low, and the closing price, well, you can see that the market's got consolidation. Should it get under 990 on a close, it's a breakout to the downside. I'd say over 1010, and you've got a market that's trying to put in a bottom. When we look at the action of the chart over the past few days, it is conclusive that there is no trend. Today's low of 994 was low enough to take out this low right back here 4 days ago of 994 and a quarter, which now gives you a higher high and a lower low. That is not a trend. Prices have stayed under the 18-day average of closes, which I call the line in the sand. Let me explain myself if you're new to watching this. Moving averages are reference points on chart, but they can be more than that, and I teach this in my charting course. When a market is under the 18-day average, it is not uncommon that if prices rally back, that becomes a resistance point. It's not uncommon if it rallies over it, it falls back and it's a support point. Does it always work that way? No. Here you were way over it, you fell down, but again, when you rallied back up, it became a resistance point. Even here, it kept hitting it over and over. So that's one of the ways. The other way that I look at it is when the market is under it, it gives the market downside bias. In other words, if price action's taking place under that average, downside bias, above it, bullish bias. Got it? It also filters my swing line. So if I have a trend in it, it might say, well, if you got a sell signal and you're under the 18-day average, everything's bearish. Now, I teach a lot more than that in my course. Believe me, it's 54 chapters. But it's the gist. That's all, not the key points, the gist of how it works. When you have no trend and you're under the 18-day average, you got what? You got downside bias, and that's how I look at it. The market had hit the lower Bollinger Bands, and for those of you that watch my videos over time, you know the importance of them. If not, I'll cover it as we get on down the road here. But suffice to say, that's the support zone, and the market bounced away. And if we look at the slow stochastic, it is embedded. Now, what does embedded mean? Typically, a slow stochastic bounces between 30, well, actually 20 is the way that it's taught, between 20 and 80, back and forth. I discovered years ago, and I have absolutely kept up with it on a daily basis, believe it or not, that when the number gets under 20 and goes sideways, it changes the complexion of the market. What it does is it embeds. It locks in a bearish bias. If it were over 80, it locks in a bullish bias. So until it's lost, which takes the red line called the K line, which is the value of 1397, until it closes over 20, the odds favor that rallies in this market will continue to be sold. This noise doesn't influence the thinking. The pros are still looking to be short sellers. The same things that work in the meal. You have the embedded reading, but here's the difference. Here you have lower highs, lower lows under the 18-day average. Now this is the second day in a row that you've gotten down to the lower Bollinger Band with an embedded reading. It's called riding the band. And that could become a very bearish situation that even drives prices lower because you've got a built-in bear bias, and now the market's not getting away from that support zone, it's just sitting on it. Soybean oil, which was the weak sister literally all of this year, is suddenly getting some life into it as spread reversals, the crush reversals happening, and it's getting the bid as the meal market's becoming the market that is weighing the market down on the crush. So it's gone up in value as the meal's gone down, and it's in an uptrend right now. Feeble, but an uptrend. Higher lows, higher highs over the 18-day average. Should it want to extend the rally? Potential resistance, 34.86 to 35.15. The green is the 100-day average of closes. In the corn market, you're still very much in the bear camp, looking to see if you can reach down for the lower Bollinger Band. Not there yet. And you've got an embedded reading. Again, still very bearish, nothing friendly. Same in the wheat, riding the lower Bollinger Band, now with an embedded reading. What's the common theme? Lots of embedded readings here. Very bearish situations. Rallies will still be sold until that reading is lost, I think. That's my interpretation. On the chart action. In the sugar market, an embedded reading. Are you getting a theme here? Look at how the market just keeps falling to that Bollinger Band and again riding it. Rallies probably going to get sold hard again by the pros. Coffee market. Well, it got up to the upper Bollinger Band and immediately fell back to the 18-day average of closes. Momentum flat. You don't see it drifting one way or the other. This is a market that's in an uptrend. Up until today's close, it closed under the 18-day average. That neutralizes it. To get it going again, you got to close over that 18-day average. And if you take out 140.40, you destroy all the chart action, and then you just start trading, I think, between the upper and lower Bollinger Bands in a chop action. In the cocoa market, this action was bullish as it turns out. And you've now got patterns of higher lows, higher highs, riding the upper Bollinger Band. If you can extend the rally, you might make it to the 100-day average at 22.05. I think getting beyond there on the chart will be a difficult task. You are overbought, not embedded at this point. In the cotton market, notice how the market lower highs, lower lows. It's trying to settle or close the settlement price under the 18-day average. That is still bearish action. It is an oversold territory, though, and that becomes dangerous to get short on. Now, I've switched over to the June cattle from the April. Look at how powerful this is. Embedded reading. Now you're bursting out this action. Now, I want to show this. This is very important. We said we'd talk about Bollinger Bands. Bollinger Bands often go sideways, and then eventually they have to decide out of that what trend are they going to take on. And the longer they go sideways, and this is not the classic sideways pattern. You'll see that in some of today's videos in other areas. But when it starts breaking out, it has to do it by getting up to the upper Bollinger Band, and it's often accompanied by an overbought condition like you have here. Now the question is, what is it? Well, there's certainly nothing bearish. You've got higher lows, higher highs, but you are overbought and you're over the upper Bollinger Band. You only stay over a Bollinger Band 5% of the time. There we are with the market, and you can see what it's doing. So it gets over, it pulls back under, now it's back over, and it's bending this band out. That's very bullish action. I looked back where this market was about 2 years ago. There's room here to run historically, so don't fight this market. You got the same thing with the feeder cattle. Higher lows, higher highs, fighting with the Bollinger Band, and today blasting off again. It's not excessive over it. It's one day, because the other day you came down I'll do counts with you at some point here, but now the question is the market is staying underneath the upper Bollinger Band there, and now it gets back over it. It's one day over. That's how you look at it. Here's what I look at, the bullish embedded reading. And in the hog market, hogs have been bearish. They've traveled from the upper Bollinger Band to the lower in no time at all. They are oversold as can be, under the 100-day average and at the lower Bollinger Band. Doesn't mean they can't go lower, but the odds of them pushing a sharply lower from here get smaller and smaller now. Bounces are probably needed in this market for it to consolidate and see what it's going to do next. And that brings me up to this, which is something that I think that you might want to take a look at. Let me tell you what Consensus is, because I've been with them in reading their publications and a contributor for God knows how many years. Now, I'm not contributing right now with them, and that's only because I want to put videos up on their site, and that's what they have to get to. But what I do, and when I write a gold report, they'll get it, and I read a couple a year, but you get to get all these newsletters in one spot. People want to contribute. They're trying to get you to read their letter, hoping that they'll get you to want to trade with them because you like what they're saying. Look at all these different contributors. I'm talking hundreds. Then they take the newsletters, they categorize them, and they create a bullish sentiment. How many are bullish? How many are bearish? And they publish that each week. That in itself I find very valuable. So you get a 4-week trial. It's all online. You're going to get an email or a user ID and a password from them. You'll come in, you can read everything in one spot. You get their consensus. I think it's a great source. How do you get this? It's free, by the way, from us. All you need to do is give us a call at 866-973-2077. You can go to our website, www.iraepstein.com. You can click up here if you're watching us on YouTube, and with that you'll see other offerings as well. Choose what you'd want. Or underneath us on some websites it says click here, click, the form will appear. We'll take it the rest of the way. I'm Ira Epstein. Thanks for watching, and I'll see you tomorrow.